Hello, this is Corner Invest. Today I'll be talking about quality stocks that are trading at its lowest valuation in its history. So in today's video, we'll be covering a few things. We'll be covering the quality stocks, we'll be covering market conditions right now, as well as some questions that you guys have left me in the comment section below. So let's talk about the first stock first. The first stock is none other than United Health. So for United Health over here, since its earnings is down around 33% and almost every day the stock has been falling, currently now it's trading at a 16 times earnings. So if you were to look at United Health's valuation, for example, United Health now is currently trading at 16 times earnings with the mean at around 20 times earnings. So it is currently now around 20 to 30% discounted from its average valuation over here. And I think this company is presenting quite a decent opportunity right now. As for United Health over here, I did a EPS calculation over here, and assuming a 10% EPS growth for this company and a 20 PE, which is quite doable given the predictability of this business, currently now United Health will give you around a 16% annualized return. That is more than double your money over the next 5 years, and that is usually when you want to buy your stock over here. So for United Health, it clearly shows that the company is quite undervalued at this price, and for me, I've been buying a bit of United Health already. So for United Health, this is their business. They are the largest insurance provider in the US, so the insurance portion makes up around 70% of their revenue, whereas the Optum Health portion makes up around 30%. But if you're to break it down into the net income itself, Optum Health makes up around 50%, insurance makes up around 50% on net income as well. And for United Health over here, they have the largest customer base to basically drive to Optum Health, and that has always been the story for United Health over here. So these are some of United Health's headwinds. So number one, United Health is facing a lot of bad sentiment. So given the Luigi case last year, and currently now you're seeing headlines almost every single day on United Health. And so there's a recent one over here which says United Health sued by shareholders over its reaction to backlash from executives killing. So clearly it is all driven by bad sentiment surrounding the killing of their CEO last year. And the other bad news was in their earnings itself. So for United Health over here, they missed both on the EPS as well as the revenue itself, and they lowered their guidance by around 10% or so. So it went down from around $29 of EPS to around $26. That was around a 12% revision downwards. And the stock is punished by being down around 30% since pre-earnings itself. So if you're to consider some of United Health's tailwinds, so the first tailwind over here is the Trump Medicare drug price plan. So what he's basically thinking of doing is to basically lower all your prices for all your different drugs over here, and that will be bullish for your PBMs over here because it will increase their margins over time. And for United Health, they have a large segment in Optum RX, which is the PBM portion of their business. It is an extremely profitable one, and you will likely see more profits coming in if the drug prices can come down. Next tailwind over here is just the Medicare itself. So for United Health over here, they've been facing price pressures from Medicare itself. So they're saying that Medicare users are basically visiting the hospitals a lot more, which leads to an increase in their medical loss ratio, which was what they reported last quarter and what they are expecting in the next few quarters as well. And so this headline over here is basically saying that Trump is trying to force seniors into paying for a more expensive Medicare Advantage plan. So if they can increase the prices for the Medicare plan, and then obviously this is extremely bullish for the healthcare insurance industry in the US. And so overall, the tailwinds and the catalysts are there for United Health to basically recover from this decline. It is mainly just a sentiment problem right now with this stock. So this is my United Health summary. So United Health is extremely discounted right now. My fair value for United Health is around $500. Currently now is around 25% margin of safety from its fair value. This insurance giant won't go anywhere, and the management said in the last earnings call that most problems seen can be addressed quickly. So my personal belief is that all of these problems, yes, they can be addressed very quickly because it was all tied to the Luigi and the CEO case last year. So if you're to just look at United Health's earnings as compared to another company like Elevance Health, CVS, Elevance, Humana, all of them beat their earnings because they had nothing to do with the Luigi case over here. But for United Health, I think what they did was they tried to give out more claims because of the Luigi and the CEO case over here, which led to a much higher medical loss ratio as compared to what it previously forecasted. So for United Health, I think it is a company that is discounted right now. It's a good buy at this price, and I've been adding into this one as well. I'll be looking to add even more when it goes down to around $360. Next stock is Google. So Google is currently a company that is trading at 17 times earnings and now around 18% year to date. So for Google over here, this is their valuation. Google is currently now trading at a 17 times earnings, and if you have to look back at its history itself, it has never traded at below this valuation. So its current valuation is the lowest point in the past few years, and I think Google's valuation should be similar to Meta's, around a 22 to 24 times earnings. That will be the fair value for Google over here. So for Google, this is the EPS calculation of their fair value over here. So Google at $8.98 of EPS over here, and assuming a 13% EPS growth over the next 5 years, which is extremely doable given the growth in cloud, in YouTube, in even Waymo itself, although Waymo is not profitable yet, and assuming a 20 times earnings for this company, which I still think is undervalued. I believe it deserves around a 22 to 24 times earnings. This company over here will give you a 16% CAGR over the next 5 years. So similar to United Health, this company is deeply discounted right now. And I do believe that as long as Google can continually put out these numbers, the stock price will eventually catch up to its fundamentals over here. So for Google over here, this is the update from what Apple and EdiQ basically published yesterday. So what they're saying is that we continue to see overall query growth in search. That includes an increase in total queries coming from Apple devices and platforms. More generally, as we enhance search with new features, people are seeing that Google search is more useful for most of their queries, and they're accessing it for new things and in new ways, whether from browsers or the Google app, using their voice or Google Lens. We're excited to continue this innovation and look forward to sharing more at Google's investor presentation day. So for Google over here, what they're saying is that the Apple devices, there's still growth. So contrary to what EdiQ said yesterday where the searches are coming down, Google is claiming that the Apple devices search queries have been going up over the past few years and is still continually doing so. So yeah, there's confirmation bias on both sides, pick a side. But for me, I think Google, as long as they can hold the numbers, I wouldn't sell this stock. So for Google's story over here, it's simple. So Google Cloud is growing rapidly. Google YouTube is still a juggernaut as it is. Netflix is priced at around 54 times earnings, around a $500 billion market cap. So for YouTube over here, it's a superior business to Netflix. So I do believe that YouTube itself should be priced at a similar valuation as Netflix. YouTube without their subscription portion also does more income as compared to Netflix over here. So Google alone should be worth around $600 billion already. And then you have Waymo that is doing around 250,000 rides per week. And you have the Uber CEO coming out and saying that Google Waymo is leading in the AV market over here. But the problem with Google is this is my worry with Google. So I'm worried that Google search could someday become like this, where it just stays stagnant for a very few years and then there is a sudden decline over here. We don't know how steep this decline will be. We don't know when this decline will come. And if this decline comes, then it'll be catastrophic for investors like myself with a large position in Google. But overall, I'm still bullish on Google. I'll be holding on to this stock until the number shows that there's some weakness in Google search. That'll be when the TCs changes for this one. Overall, my thesis for Google still stays. It'll be a diversification out of search into all your different other revenue streams over here like cloud, YouTube, Waymo eventually as well as it turns profitable. Third stock over here is Amazon. So Amazon currently is trading at a 31 times earnings and year to date I believe is down around 15% or so. It's similar to Google, around 25% down from all-time highs. So for Amazon over here, the current valuation is at around a 31 times earnings, and again, it has never traded at this valuation. This point over here was when it became negative earnings, so the P ratio was below 0. But overall, if you're to look at the history itself, Amazon has never been cheaper at this price. So for Amazon over here, this is the EPS calculation over here, assuming a 15% EPS growth for Amazon, which I think is extremely doable, and assuming a 28 times earnings for Amazon, so multiple contraction as well as reduction in growth. These are conservative estimates over here. Amazon will give you around a 12% CAGR over the next 5 years. I think the stock price now is attractively priced. The fair value for Amazon should be around $200 to $210 in my opinion. So currently now you're still getting a discount if you're buying into Amazon over here. So for Amazon over here, here are some of the headwinds. So it will be mainly just tariffs because China makes up around 50% of their third-party sales. And I believe that the China deal will come in the next 2 years or so. It won't be so fast. It will take a while, like back in 2018 when the deal actually came in 2020 instead of 2018 when the talks started. So it should take around 2 years for the deals to come. And during that 2 years, Amazon's earnings in terms of your third-party seller services could be hit as well because 50% of the third-party sellers are from China itself. So another headwind is simply just the capex not paying off. So currently now Amazon is investing a lot into capex, and if the capex don't give them ROI, then the problem with that is it will lead to a lot of depreciation over time, which will hit their earnings statement next time in the future as well. But the tailwinds for Amazon is this. Amazon is probably the strongest moat company in the Mac 7 beside Microsoft and possibly Apple, trading at a discount relative to them. AWS continues to grow, as you saw with the numbers in Azure and GCP as well. And overall, the demand now is still larger than the capacity that they have. And another bull case for Amazon is simply just the margin expansion. So this stock over here has a lot of room for margin expansion simply because the margins itself are extremely low. And if you're to just increase their margins in terms of subscription to Netflix levels, in terms of their advertising to Google and Meta's levels, then you will see a lot of earnings growth in this company over here. So for Amazon over here, this will one day become one of my largest holdings. This company is transitioning from chasing market share to profitability, meaning a shift from growth to predictability. So I like my companies when they move from a growth phase into more of a predictable phase and a profitability phase. That is when the companies are usually the most predictable, and that is when I would like to buy into Amazon over here. And that is the vision that they're trying to put out right now. They're trying to increase their cash flows over time. They're trying to increase their profitability over time as well. Next portion, this is the state of the markets right now. So this is what Donald Trump said about the stock markets in general.
And Speaker Johnson and Leader Thune have done an incredible job. I mean, I'll let you know we have to get a vote, but we have a lot of support for that bill. And if that happens on top of all of these trade deals that we're doing, this country will hit a point that you better go out and buy stock now. Let me tell you, this country will be like a rocket ship that goes straight up.
So I mean, Trump, what he's basically saying is he's urging people to buy stocks. But if you're to look at the markets, so the markets now have recovered to pre-Liberation Day levels already. But if you're to compare it to pre-Liberation Day itself, we're currently now in a worse economic condition. Because pre-Liberation Day, we had no tariffs. Currently now we have one deal with the UK, which is the 10% tariffs over here. And we have about 70 more days to make deals. And so far, one deal has been made. So the rally so far is pricing in a lot, in my opinion. So I think this rally might not sustain for a very long time. But for me, this is what I'm doing. I'm buying when valuations make sense. I'm hoping for more downside, of course. Warren Buffett bought nothing in Q1, which is very telling of what he thinks about the market conditions and the market valuations right now. And this is also what he said in Q1 itself. So this is what Warren Buffett thinks.
The first quarter ended March 31st, and it did show that Berkshire's cash pile expanded from the end of the last year. But the greatest market turmoil came in April. Martin Devine, a shareholder from Scotland who is attending the meeting today, wants to know, has the recent market volatility presented Berkshire with opportunities? And Martin just wrote in an addendum in the last 40 minutes or so, pointing out that you mentioned Berkshire almost invested $10 billion recently, and wanting to know if you could talk more about that.
Well, then I can give you a good answer to the second part, which is no. But 10 billion wouldn't have done that much, you know. That's the other side, another side of it. What has happened in the last 30, 45 days, 100 days, whatever you want to pick up, whatever this period has been, is really nothing. There's been 3 times since we acquired Berkshire that Berkshire has gone down 50% in a fairly short period of time, 3 different times. Nothing was fundamentally wrong with the company at any time, but this is not a huge move. The Dow Jones average hit 381 in September of 1929. It got down to 42. So that's like going from 100 to 11. This has not been a dramatic bear market or anything of the sort. I mean, it was, you know, like someone pointed out, if I've had 250 trading days a day, you know, for however many years I've been old enough to trade stocks, got 17 or 18,000 days. There's been plenty of periods that just are dramatically different than this. I mean, when the day I was born, the Dow Jones was at 240. And that was August 30th, 1930. And between that and the low, it went from 240 to 41. I mean, so if people think that it made a really major change, it if it gone up 15% instead of down 15%, people they take that with remarkable grace. but if it makes a difference to you whether your stocks are down 15% or not, you need to get a somewhat different investment philosophy, because the world is not going to adapt to you. You're going to have to adapt to the world, and you will see a period certainly in the next 20 years, you'll see a period that will be in what somebody in the market described one time as a hair curler compared to anything you've seen before. I mean, that just happens periodically. The world makes big mistakes, and surprises happen in dramatic ways. And the more sophisticated the system gets, the more the surprises can be out of right field. That's part of the stock market, and that's what makes it a good place to focus your efforts if you've got the proper temperament for it, and a terrible place to get involved if you get frightened by markets that decline and get excited when stock markets go up. I don't mean to sound particularly critical. I mean, I know that people have emotions, but you got to check them at the door when you invest.
So last portion over here, I'll be talking about some questions that you guys have left me over here. So first one over here, it says, hello, what's your opinion on NVIDIA stock price? Is it a good buy right now and hold for future? So for NVIDIA over here, my problem with the business is it is too concentrated in the AI play. So if you have to look at from the start of NVIDIA pre-AI as compared to now, the earnings have exploded simply because of the data center revenue over here. And so for NVIDIA over here, the problem is it has too much weight on it, simply because the entire play for NVIDIA is just the AI play. And you have other competitors as well, such as your TPUs from all your different other Mac 7 companies. And then you have AMD that's 1 year behind NVIDIA as well. And then the only thing that's holding up NVIDIA right now is their CUDA library. I'm not too sure what the moat is there. But for NVIDIA over here, if you have to compare to all your different other Mac 7 companies as well, your Mac 7 companies, they are scalable because they have some touch point with all your different consumers. But for NVIDIA over here, they have no touch point with consumers. And so I think sustaining a $3 trillion valuation for NVIDIA won't be sustainable in the future. So for me, I think NVIDIA is a risky bet right now. I don't understand the business enough. And for me, I think the better AI play, the more predictable AI play is in either ASML or TSMC. They're not directly related to NVIDIA. Of course, the stock price will be, but the fundamentals itself, they are detached from NVIDIA and all your data center revenue as well. Next comment over here, it says Microsoft 2012 PE 12, Apple 2015 PE 11, Meta 2022 PE 12. All these were fantastic buys. As you said, these premium big tech companies don't trade at those valuations too often, and it's often when there's a narrative that the company is being disrupted. Google is already a buy. If that 12 PE valuation comes into play, it will become my biggest holding over here. So for Google over here, I agree with whatever you said. So Apple in 2015, when everyone was just calling it a hardware company selling phones. Microsoft in 2012, when I believe they had some form of breakup issue over here. Meta in 2022, when everyone was calling it a dying social media business. I think Google is currently facing the same scenario as well. And so for me, I've been buying into Google as well. Google is one of my largest holdings already. So let's just see how the numbers play out in the next few quarters or so. If they come in strong again like what they've been doing over the past few years, then Google search is here to stay. And Google is definitely here to stay as well. I hope you guys have found this one useful and invest safe.